Thank you all for coming. It's a great pleasure to be here. The global financial crisis has obviously involved many dramatic and even unprecedented events in the past 50 years at least. And I'm sure that economists are going to be left trying to understand and analyze these events still for some time. In today's lecture, I'm going to talk about one aspect of recent developments that have certainly been quite dramatic and surprising, and that has to do with the remarkable changes in the kind of policies that central banks have been using over the past 3 years or so to try to respond to the crisis. As you all know, prior to the crisis, monetary policy was often discussed in terms of a single type of decision, a single instrument, namely the central bank's choice of an operating target for some overnight interest rate. In the case of the US, that would be the federal funds rate, and so the Federal Open Market Committee would meet 8 times a year at least at regularly scheduled meetings to choose a target for the federal funds rate, and other central banks have similar policy rates that would be the focus of their decisions. In these policy deliberations, typically little attention would be given by the policy committee itself to the operations that might be required to implement that target. It could be taken for granted that other people would know what direct market interventions would be necessary to, in fact, keep overnight interest rates close to that target. Now, since the crisis, of course, things have looked quite different. First of all, many central banks found themselves facing larger difficulties achieving their targets for overnight interest rates. Moreover, the tight relationship that had typically been observed before between the policy rate and other money market interest rates often broke down, or at least became much less simple, raising a question of whether simply focusing on achieving the target for that particular rate was sufficient or not. Quite apart from that, at least since the end of 2008, a lot of central banks found themselves reaching an effective lower bound on either where they could or where they were willing to move overnight interest rates, so that to the extent that further stimulus seemed to be needed, talking about it in terms of your target for overnight interest rates was no longer going to be a possibility. And as a result of all of these things, we've seen extensive use of other dimensions of policy than simply central banks' adjustment of their targets for their normal policy rates. Well, so what have central banks been doing instead? What are these other dimensions of policy that have been important? Well, first, we've seen a very substantial increase in the overall size of the balance sheet of many central banks in response to the crisis. Here's a simple comparison of the size of the balance sheets of the ECB, the Fed, and the Bank of England, normalized by the GDP of the various economic areas. And what you see in each case is a very dramatic increase by the first half of 2009 relative to the size of the balance sheet the year before in each of those cases. How it happened and what was being done is a little different in the different cases, but the pattern of dramatic increase in the size of the balance sheet is, in fact, similar. In some of these cases, and this is definitely true of the Federal Reserve, what was happening with this big increase in the balance sheet involved a very large increase in the supply of bank reserves. And so this is another dimension of policy which is being used in new ways, or at least arguably being used in new ways. In the past, the Fed would adjust the supply of bank reserves as the main way it would implement changing targets for the federal funds rate, but the increase in the supply of bank reserves we've seen since late 2008 is much, much larger than what would have been needed to achieve a particular federal funds rate target. Many people have characterized this as a shift toward an approach to policy that's called quantitative easing, and I'll talk more about what that means. First, I want to just point out the dramatic change in the behavior of the supply of bank reserves, which is the green region here on this graph of the liabilities of the Fed. So before late 2008, there were bank reserves as part of the liabilities of the Fed. As you can see, a little bit of a green strip there. It was often less than $10 billion. It's a very small part of the overall liabilities. There's a very dramatic change that occurs from October of 2008 and onward, growth to more than $1 trillion of reserves. And that's completely out of scale with the types of variations in the supply of reserves that occurred before as the Fed would adjust the federal funds rate target up and down. And so talking about what that might have achieved is one of our main goals. But there's also been important changes in the composition on the asset side of central bank balance sheets. So there have been the creation of new types of liquidity facilities and changes in the terms of lending under existing liquidity facilities. Many central banks lending for longer periods of time, accepting broader classes of collateral, lending to a broader set of counterparties. We've seen direct extensions of credit to the non-financial private sector by many central banks, and new types of asset purchases, shifts of asset purchases to longer maturity government bonds, in many cases, certainly including the Fed, purchases of non-treasury securities, certainly an important change in the Fed's behavior. Here is looking at the asset side of the Fed's balance sheet, and you can see what I mean about the change in the composition. Before the crisis, so until late in 2007, the composition of the asset side was pretty boring. Basically, the Fed held treasury securities and, in fact, almost entirely relatively short-term treasury securities. There were a little bit of other things, but basically that was the story. So when they would vary the supply of reserves, they would adjust their holdings of treasuries, and that was about it. Since the crisis, there's been a dramatic change, not just in the size, but even before the change in the size occurred of the balance sheet, there was important changes in the composition of the asset side. You see the creation of the term auction facility, that's that light blue region labeled TAF, a new lending facility that the Fed set up in late 2007 to get funds more effectively to depository institutions. You see big growth in swap lines to foreign central banks, including the ECB. A bunch of other new liquidity facilities that aren't all separately broken down became important by 2008. You see things like the commercial paper funding facility coming in late in 2008. That's the light blue region at the top where the Fed was directly buying commercial paper. Later, over there to the right, you see a purple region labeled MBS that becomes very big. The Fed began purchasing large quantities of mortgage-backed securities. You see the green region, the agency debt. So all kinds of new types of assets suddenly becoming important parts of the balance sheet. So what should we think about these changes and what they mean and what they're trying to accomplish or what they do accomplish? I want to talk in particular about a couple of views of this, which are in fact rather different. One familiar view, and that I'm sure you've heard about, is the idea that these policies should be interpreted as quantitative easing. And so the theory of quantitative easing is the idea that an increase in the supply of bank reserves should provide additional monetary stimulus, and that it should have an effect even if it doesn't involve any further reduction in overnight interest rates. And the idea for this is that the increase in the supply of bank reserves increases the monetary base, or what Milton Friedman used to call high-powered money, and that this increase in the monetary base should serve to stimulate aggregate demand in its own right, quite apart from what its consequences for interest rates might be. Now, there's another view, though, of what's been going on, certainly of what's been going on, say, at the Federal Reserve, despite the fact that the supply of bank reserves did dramatically grow. This is from a speech by Ben Bernanke in London back in January of 2009, in which he said the Fed's approach to supporting credit markets is conceptually distinct from quantitative easing, as used by the Bank of Japan. He says in a pure QE regime, the focus of policy is the quantity of bank reserves. In contrast, the Fed's credit easing approach focuses on the mix of loans and securities that it holds and on how this composition of assets affects credit conditions for households and businesses. So he says the point of the Fed's policy is not that they're trying to target the quantity of bank reserves, it's the composition of what they hold on the asset side of the balance sheet that is actually the point of the policy. The approach I've suggested is that when financial markets are functioning relatively efficiently, I think it is correct to view monetary stabilization policy as basically a one-dimensional problem as it was viewed before the crisis. Why is that? Well, I think under conditions when financial markets function well, what you should be doing with the composition of the central bank's assets is in fact to follow a traditional policy like the one that was called treasuries only in the Federal Reserve System. Why? Because if financial markets are functioning well, the composition of the central bank's asset holdings isn't going to matter very much for aggregate outcomes, and then there are prudential reasons why it's in fact safer for the central bank not to get involved in the allocation of credit and purchases of particular assets. With regard to the supply of bank reserves, I would argue that, again, when financial markets are functioning relatively efficiently, the best policy is to maintain a constant, relatively small spread between your target for the policy rate and the interest rate that you're paying on reserves. That kind of policy favors efficiency of financial intermediation for reasons basically that Milton Friedman argued back in 1959 when he was arguing in the US for the payment of interest on reserves. Interest rate policy is then the one dimension of policy that should be routinely varied with economic conditions. When financial markets are functioning well, you do need to vary the target for short-term interest rates as conditions change in order to stabilize inflation and the output gap. But despite the things I just said on that slide, when financial markets are sufficiently disrupted, as shown by the appearance of large and unusual spreads between different interest rates, apparent freezing of particular markets, and so on, the conclusions that you should reach are not as simple as the ones on the previous slide. In particular, central bank credit policy can be effective under those circumstances and can, in fact, increase welfare. I haven't talked about the welfare calculations here, but in my work with Vasco, I show there are circumstances under which it could be welfare improving. Basically, the idea is that under those conditions of sufficiently disrupted private markets, the central bank needs to itself intermediate, substituting for the impaired private markets. Even under those circumstances, though, I'm skeptical about the role for pure quantitative easing, as I've defined it here, and that would apply even when the zero lower bound on the policy rate is reached. Finally, in terms of the case that I've made for asset purchase policies, I think there are conditions under which asset purchase policies make sense. I do think they're only justified where you think private arbitrage is not working well. And so they should be justified by particular indicators of dysfunction in the private markets. And furthermore, I think central banks getting into that should always be wary about the risks to their independence that are increased by involvement in the allocation of credit to particular markets. So I think there are conditions under which these emergency measures can be justified, but you should always be careful about them. Thanks.